Good evening, everyone, and welcome to tonight's presentation where I'll be going through Fibonacci analysis for short-term trading. So this is part two of our Fibonacci series. So the first presentation I did a few weeks back, actually back in December, where we actually went through some of the key concepts, the key ratios that we look at, and just built upon those fundamental principles that a lot of people use when they look at Fibonacci analysis. So before we begin, my name's Jimmy Pan, and just want to quickly run through our disclaimer. So tonight's presentation is educational in nature, and that no personal advice will be provided. All information is general advice, and if you have any additional questions about CFDs or FX products, please give us a call or consult an external financial advisor. Okay, so today's presentation. So what I'm going to be looking at is looking at Fibonacci analysis and how I like to use it on a more shorter term basis. So one of the things I'll quickly do is a recap on the key ratios. If you saw the first presentation, hopefully that gave you a better idea of the type of ratios that I look at, how to identify the swing lows and swing highs, so apply these ratios correctly, and how to sort of combine multiple ratios, so for example retracements and extensions, to find ones that intersect to give us that higher probability setup or support resistance levels. So the primary time frames that I look at are the 4-hourly, 1 hour and 15-minute charts. That's when I'm more active, but I'm always looking at weekly, daily charts as well, just for more longer term analysis, because that one of the things that I found is when you actually start looking at multiple time frames, it really does give you a better feel of where the market is at, where I guess the big money is, and where generally most people are actually positioning themselves. Because if you look at a daily chart and the trend is clearly up, but you're just really focusing on like a 5-minute chart and taking every single swing move on that, that's probably the quickest way to sort of just churn down your account. And obviously your broker will be very happy because you're doing lots of trades, but in the long run, as many traders would go through, when you over trade, the margin of error is much higher, and you often start to see just all these little profits that you make, and then this one trade that comes along starts going against you. You start revenge trading and all that sort of stuff, and I often find that generally happens on shorter time frames, because a lot of these big hedge funds, fund managers, and just the investors that have really deep pockets, they're not trading off 5-minute charts. They're looking at very long longer time frames, and they're looking at very detailed analysis, and they're positioning themselves for a potential move in a particular direction, whether it's long or short, whatever that may be. And if you can sort of identify that and get on the right side of that, then that's going to really increase your probabilities of your trade entry. So that's why I like looking at multiple time frames, starting with the 4-hourly, just seeing what type of trend we're in, forming a bit of a bias on whether I'm looking to go long or short a particular currency pair or index or stock. And then once I identify a level and we hit that level, then drilling down to an hourly or 15-minute chart to try and just fine-tune that entry. The 3 key setups that I'll be looking at today, we'll be looking at extensions and retracements. So Fibonacci retracements, I think that should be, if you're looking at Fibonacci analysis, this is probably one setup that you want to really know inside out, and it's just really being able to identify a swing low, swing high, draw the Fibonacci retracement level, and then just seeing which levels you want to get in at. So if it's a strong trend, then getting in on shallower pullbacks. If it's a trend that's kind of going sideways, then looking for deeper pullbacks. Or if it's a nice healthy trend, then just looking for a 50% or 61.8% pullback, because they're a lot of the levels that I know a lot of proprietary systems are sort of based around, and it's aesthetically pleasing to the eye when you sort of see a move come back about halfway, and if you like the stock, you generally want to get back in on that, because you're like, what, it's 50% cheaper than what it was a few days back. why not? You know, that type of you know, levels and using fib levels to be able to identify those. Fibonacci confluence levels. So when I jump onto the charts, I'll show you, you know, some of the various combinations that I use to try and find levels. You know, if I looking at certain currency pairs, and I know, you know, we're sort of in a dollar bullish mode, for example, then I'll be looking for long entries on, let's say, dollar yen. I'll be looking at short euro USD, and just, you know, really looking for those entries there. One of the things that I went through early on in my trading career is essentially just trading both directions in a single session. So I could be going long and then short and then long, then short on a single pair. And some nights, you know, these fib levels work great and you hit it, you know, pretty accurately. But more often than not, I've found that, you know, I was doing way too many trades, way too many break-even nights, and, you know, and then some of these losing nights sort of crept in, and you just sort of, you know, not really really focus on, you know, good entries, and you just really just, you know, just trying to trade anything that moves for the sake of trading. So sort of mindset's changed a lot now, so that's why looking at more longer term time frames, which allows me to look at more currency pairs rather than sort of, you know, looking at Euro USD and just looking at like a 1, 5 and 15-minute chart. Like it's fun, you know, if you want to day trade, but I think in the long term, when you're sort of learning how to get, you know, learning at more shorter term trading, then it's probably better to stick to longer time frames, you know, really refine your craft and sort of, you know, get a few of these key setups under your belt. And, you know, the more analysis that you do, the more intimate you get with certain currency pairs, indices or stocks, and you'll be able to know, okay, you know, on BHP, I'm waiting for, you know, a retracement on this particular level. On CBA, I might see a confluence at this level, and then you move on to the next opportunity. On the Aussie dollar, I'm seeing, you know, an extension here, looking to short there. You know, just it allows you to, and then if you've got a journal, it's great. You jot all these things down, and now you've got a little, you know, playbook of entries that you're looking for the week ahead. So, you know, there's I think, you know, once you really get into it, that's what you want to sort of form, just like a trading plan, bit of a guide on what you're going to do for the following week. And that's one thing that, you know, Fibonacci analysis has allowed me to do, is sort of plan ahead, look for key levels, set my alerts up, and then, you know, sort of plan to trade from there, rather than sort of just sitting in front of the charts, you know, 8 hours a day and trying to get in and out. You know, just, you know, as humans, you know, we get very impatient, and I don't think we're wired to really just sit there. Some people are, don't get me wrong, but, you know, I think for the vast majority of us who have things outside of trading, you know, you want to sort of develop a system that can sort of work around your lifestyle. Next thing, you know, I'll just look at, you know, when I'm doing some live examples, just combining Fibonacci levels with other forms of analysis. So that may be looking at, you know, Fibonacci with, let's say, RSI, or Fibonacci with trend channels. If they're intersecting, great, because that's going to give me a lot more confidence on a particular level. And when it gets to a particular level, I know exactly what I need to do to trade that. So other things too is something that, you know, I've used probably more in recent times, which is incorporating Fibonacci bar counts, is trying to incorporate some new things to improve my trading, where I can actually keep, you know, staying to trades a little bit longer. For example, you know, if I'm trading a fairly active market, then I might wait for like a 5-bar move. If I'm trading maybe a slower market that's not really, you know, the ATR might be very low, etc., then I might be looking for a 8-bar move or a, you know, 21-bar move. And, you know, I'm starting to see these really pay off, because what it has sort of helped me do is not to get too caught up when, you know, you see the position go in your favor, then it starts to pull back. And the first thing you want to do is, you know, especially after a few losing trades, you go, oh, I'm going to take that profit. And you take the profit, and it was only just that first little shallow pullback before it continues on, you know, on that particular trend. So they're probably my most frustrating trades, when I nail the entry, but then the actual exit, I don't follow my rules and I get out too early, and that's usually, you know, after like a losing trade and trying to just get something back. With the Fibonacci bar counts, it sort of helps me, you know, sit on my hands, just wait for the trade to develop, and, you know, you sort of get over a bit of that noise, and then you start to see that real thrust up, into that profit target area that, you sort of set out. So looking at some of those, and of course, looking at some live trading examples towards the end. So yeah, guys, I really do appreciate you taking the time tonight. What I will be looking at towards the end of the presentation as well. There's some Q&As, and yeah, and let's get started. So firstly, some of you might be familiar with these slides. So Fibonacci analysis, what is it and how do we profit from it? So, the ratios are just derived from the Fibonacci number sequence here. You can see how it sort of spirals out, and these ratios, repeat over and over in nature. Architects use it to sort of, in their design work. Engineers use it. You can see we've got a nice ratios broken down on this particular Ferrari here, and just for a little bit of a giggle, you can see Donald Trump's hairline is sort of, in accordance to that Fibonacci ratio as well. But the key ratios that we'll be looking at is for retracements, 23.6, 38.2, 50%, 61.8, and 78.6 retracements. So this is, the ratios that I'll be looking at when I find, two swing points, a swing low, swing high, apply the Fib ratio, and then measuring the pullback. Now, I'll be getting a lot of emails about Fibonacci ratios, how to add them in MT4, things like that. Please don't hesitate to give us a call. The guys on the sales and support team, they're happy to help you out with that. I'm not always available. I'm not always at my desk, so it's best just to call up, speak to them. I've already shown them how to do it, so they'll be able to do the same for you as well. Looking at the key Fibonacci extension ratio, so 127.1, 161.8, 261.8. So the 261.8 extension, that's something that I'm going to be talking about quite extensively, and that's going to be one of my favorite short-term scalp setups, where I do a direct Fib extension. Looking at that Fib extension, once it hits, just taking a really short-term, position on that. So that I just purely use just on a 15-minute chart and the 423.6 extension. So the ones in bold are the ones that I see often come up more frequently when I apply the Fibonacci analysis. And, the ones, so the 78.6 and the 127.1, they're not by default in MT4, but you can certainly add them in there, and we can certainly show you how. The intraday time frame, so just to sort of run through a bit more detail, so to give you a bit more context, so looking at multiple time frames allows us to focus on high probability setups by filtering out the noise and providing confirmation of these setups. So looking at the 4-hourly chart, the 4-hourly chart often gives you, more data on the actual chart itself. So that allows you to look at, multiple swing points. You have more time to sort of digest the information, set up your charts, analyze the charts before sort of taking that trade, because it's not like you're looking at a 1-minute chart where you really need to make a decision every minute, just depending on what bar is printed, what candlestick formation is there, and what type of crazy divergences we see on the RSI or whatever other momentum indicator that you use. So looking at the 4-hourly chart, it really does help me filter out the noise. Looking at where we're in a consolidation period, where we're in an impulse move, whether we're sort of in a range-bound market, they're some of the things that are fairly easy to identify when you look at a 4-hourly chart, because the charts aren't moving rapidly, and you can just take some time and form that analysis and get the price levels ahead of time that you want to trade on. So identifying the swing low and swing high points to apply the Fib levels. Highlight the key areas for possible trade entries. So, we're looking at retracements, then applying the Fib retracements, highlighting, the 50%, 61.8 or 78.6 retracements, whatever that may be, looking at possible confluence levels as well. And then this will give you a bias on whether you're looking to go long or short. So you're not sort of caught in both directions. So if your strategy is to buy on a dip, on a retracement, then stick to that strategy. Don't go, okay, look, it's currently trending down, I'm going to try and short this into that retracement area. That's not a good strategy because, for us, we're waiting for this high probability move to confirm. And, if you think the market's going to do something, often it will prove you wrong and it will do the complete opposite. So if we're waiting for a retracement, if it never gets there, then we move on. We readjust and we readjust the swing low, swing high points to get the new levels, and then we move on to the next instrument and analyze that and keep repeating that process. We don't sort of get hung up on just the one thing at each time. So the 4-hourly chart, again, you're looking at longer term players, generally traders with deeper pockets, position themselves for longer term moves. So you want to really get to know that time frame quite well if you're trading on an intraday basis. The 1-hourly time frame, so this time frame I generally use just to sort of act as confirmation. So if I see a downtrend on a 4-hourly chart, then I'm looking at the hourly to confirm that. I'm also looking at the price action on the 1-hour chart because sometimes, if it does find a short-term top or bottom, you'll see the 1-hourly chart, they'll often exhibit, reversal candlestick patterns quicker, such as, some long tails, some, divergences, some, little double tops that you generally wouldn't see on a 4-hourly chart. You only see that as a single bar, but you might see, a small double top on the hourly time frame. And then, applying additional Fibonacci analysis if we get to see that. So, and then lastly, drilling down to a 15-minute time frame for trade entry. And I'll show you some examples where, if you were to enter on a 4-hourly time frame versus a 15-minute time frame, sometimes the difference in pips in terms of the entry could be 15 to 20 pips. So because we already know the levels ahead of time, you wanna sort of optimize that and try and get in. Obviously with confirmation, but we do that by looking at a shorter time frame. So I like the 15-minute chart purely just once the price level gets to a certain fib level, then looking at the 15-minute chart for that entry. So I know that if a fib level gets hit, I've got roughly about half an hour within that window to enter a trade because it's going to 30 minutes for that candle to sort of hit it. Great. The next candle, does it hold? Yes. Okay, let's get in on the next bar. So it's really, roughly 30 minutes usually once the level gets hit. We make a decision, put our trades on, and then we start monitoring it from there. So this is, I don't want to just repeat what I've just gone through, but the reason why I've got these slides here is you can see on the bottom here, on the bottom left, this 4-hourly time frame, this is generally the resolution that I have, like the zoom that I have on my MT4 platform. Sometimes I do zoom in a little bit more if I want to find an additional swing point, but generally this gives me enough information to work off. And this gives me data back until the 25th of Jan. So, roughly, this is a decent amount of data, roughly 3 and a bit, 3 plus weeks worth of bars that you can see there. And if we look at the hourly chart, it only goes back to the 3rd of Feb there. So, it probably cuts off about a week's worth of data, and you can see the charts, they already look different. So, this here is looking at this area on the hourly chart is looking at this area up here. So I'll move it over. You can see we're just looking at that area there. And then this is the 15-minute chart, and you can see where we're getting much finer now. And the 15-minute time frame, very active. You wanna make sure if you are trading a 15-minute chart that you are looking at higher time frames to confirm your entries. And if you're counter trend trading, then make sure that you've got some sort of trend channel constructed, or you've gone for very short, take profits. If you're trading with the trend, then great. Then that's generally where you want to sort of trade on a more generous basis in terms of giving it more room to sort of to move. Because we've seen just recently some of the moves on the equity markets. They've just been very, very exuberant, I guess, for lack of a better word. Like you've just, looking at the FTSE a few weeks back when it had 14 days up in a row, looking at the US indices last week, where if you look at it on an intraday basis, you're just seeing green bars on top of green bars on top of green bars on top of green bars. It was just, I haven't really seen these market conditions all too often, but when you do, it's great. You sort of make sure that you don't want to fight that trend. You definitely don't want to short those moves when you start to see those go up, because if you get in too early, and if you're fairly new to the markets and you haven't been burnt yet, then generally what I find most traders will do is they'll hold on to that losing position, and they will hold on to it long enough so that the pain threshold kicks in, they get out, and that's generally where the turning point is. So just be mindful. When you see a move and it starts to go against you, just get out, reassess. You'll be in a much better frame of mind, and yeah, it's just stuff that I've just seen over the years, and I've been caught myself in some of these moves. I just wish that when I'm on an actual position, I can write it out much higher, but it's much harder when you sort of seeing the profits and they're going up. The natural instinct there is to try and crystallize that. Okay, so here let's have a look at some of these strategies in a little bit more detail. So the three setups that we'll be looking at: Fibonacci retracements. This is pretty straightforward. I did an example in the last presentation, so I'll go through that one again, and then I'll jump onto the live charts so we can have a look at some of these in play. Fibonacci Confluence, this is one of my favorite things that I like doing when I identify a particular level of interest. Then I'm trying to find evidence where some of these other levels may intersect, and that really does highlight some key areas where I want to get in, especially if I start to if I'm, let's say, bullish on gold, for example, and I start to see a setup on gold, then I see a setup on the Aussie dollar, which generally historically has a strong correlation with gold, then that gives me confidence in that particular position. So I know that if the Aussie dollar hits this price level and gold is around that level, then there's a good chance that it may reverse. Or same thing with spot silver as well. Doing the same analysis there, they tend to generally move in line with each other. The velocity sometimes is a little bit different, where you might see silver really push up more, or you see gold push up a lot quicker. But generally, when you sort of look back and you overlay the charts, they generally move quite in sync. So just having multiple currency pairs that sort of conform, multiple Fibonacci levels, so multiple retracements, multiple extensions, retracements going into extensions, etc. All those sort of things. When you start to see that, then that really gets me get my pad out, start writing these down, set my alerts up. If I see it hit, then I'm really looking to get in on those levels. And lastly, fading the 261.8 extension. So this was more of a trade that I saw because I use the 2168 extension quite a fair bit when I'm in a trade and I want to improve on my risk to reward ratio. If I'm in already on a shorter term time frame, I'll then expand that out, which is normally on the 15-minute chart, and then I find the 261.8 extension. Often, I see the price run up, hit that level, and then pull back to around the 1618 extension, and I'll show you an example on that. I've actually got a live example on the DAX with that at the moment. So yeah, so it's one of those moves that obviously test it for yourself. It's just that I've seen it over and over and over, and it's a strategy. I don't take every single one of these, but it's just when I do see one that does exhibit the right price action, and it does have that strong impulse move up, then generally that gives me confidence that it's most likely going to pull back as well. So Fibonacci retracements, this is one particular setup that I want to re-emphasize again, because if you can really grasp this and really understand and identify where these swing low, swing high points are, then Fibonacci analysis isn't going to be that hard for you to be able to master, because when you start to see these levels, you can apply your fib straight away. straight away you're going to be able to identify, what levels you want to get in at. So these are the key ratios that we look for. We need a swing low and a swing high at this level, and then just drag, drag the fib level down to give you, the potential fib levels to enter your trade at. So for short trades, you just do the opposite. So swing high at A and then the swing low at B. Have a look to see where the price action pulls back to, and you can see at this point here it gets to the 61.8 level before it comes back down. So I mentioned this a few times during my previous presentations where Fibonacci analysis, it doesn't have to be tick perfect. If the price gets close to that level, passes that level a little bit, but the price action confirms that there is a reversal, then there's a green light there to go ahead. Like one of the things that you don't want to do is you just wait for a tick perfect entry. It doesn't happen that often. Like it does happen, but it doesn't happen that often, I can assure you that. So if we have a look at a typical setup, generally what we're looking to do is identify a swing low and a swing high. We want to get in on a particular pullback. The ratio that we're going to look for a risk to reward ratio is 1-to-1 initially, and then we can expand that out as we go. So what we do here is I tend to do this quite a fair bit, and you'll notice it as well. If I do a fib level from A to B and pull it down, you'll see the 78.6 retracement here. If I do it the opposite and pull it up, then you'll see the 23.6. I have those two there because on this next screen, it gives me an area where I tend to highlight, and that's an area of interest for me. So if it all gets hit or it pushes a bit below that, I know that if it gets there, and you can see this is where Fibonacci with other forms of analysis sort of kicks in as well. Look at all this resistance that was here, and we've pulled right back to it. So that's given me even more confidence. And even just from just looking at this visually, this range is probably very close to this range as well. So there's a lot of symmetrical and geometrical properties on this particular chart. So this is where we get in, or this is where we sort of look for. Hits this level, and now we're looking to get in on the high of that particular candle. So again, we get in at that level there. We get our first candle, put our stop loss just below here, initial take profit. It's a 1-to-1 risk to reward ratio. We're looking at a 15-minute chart for the entry. And as the market starts to move in our favor, one of the things that we can do is apply the direct Fibonacci extension from that first move up. And I chose this one because from this low to that high, it's pulled back to the 50% mark. So I'm happy with that. Extended up to this level here. This gives us a slightly better risk reward ratio of 1-to-2, and you can see eventually the price goes all the way up, hits this level, and then pulls back. So that's obviously like a textbook type trade, but to illustrate this, I wanted to use an example like that so it's nice and clear. Generally, you'll see multiple retracement setups during the week on multiple currency pairs. So this is something that you can really look for. So if you only need a few of these per week, on various currency pairs, and that could give you 4 or 5 trades. You might have 1 or 2 losing ones. You might have 1 or 2 that go right up to the 261.8, and when you sort of work out what your P&L is at the end of the week, even though it wasn't 100% win-loss ratio, but you're looking at your equity curve and your balance, you had a small drawdown and a nice bump up in your equity curve, and that's what we're looking for. It's all about managing the risk, and it's all about just seeing a nice steady growth in that equity curve and just compounding that as you sort of hit new milestones on your equity. So that's a typical retracement setup. And what I'll do is, let me just jump onto the MT4 platform, and I want to just have a look at the Aussie dollar here, for example. So let me just move this across, and okay, so This was the reason why I'm highlighting this particular retracement here. This was one that I had been sort of stalking the market, I guess you can say. So if I apply the fib on this level up here, okay. Okay, so I've got that there, and let me just move that there. So I've got the 78.6, and remember, when I do apply the fib, I always run it both ways. So let me just add that in here. Okay, so this was a level where, let me just move that up. Okay, so this was, so you can see I've got the 23.6, 78.6, drew that out. Now, initially I saw a bit of a head and shoulders pattern happening here. If you can't see it, let me just quickly draw that for you. So you got the left shoulder, head, right shoulder, came down, tested it, used this distance to measure the potential take profit. So if I'm just going to use a box to do that. So we take that, then I'll move that down. So we move it, measure it from the neckline. So it gives you that particular area there, and that sort of was quite close to the 61.8% retracement. Now, when I saw this move, came down, hit this level, you know, I got in around here, started to go up. As it hit the 200 period moving average on the 4-hourly chart, I was like, doesn't look too convincing. I'm going to get out sort of on there. So sort of scratched that trade. It was profitable, but only by a small margin. Got out. Now, once it came down and it hit this level, that's when I sort of got interested again, because I was looking at multiple divergences. So this is looking at, incorporating other forms of analysis. So you're seeing, a low here, higher low, low, lower low, and lower low. Now, this hit the 23.6 level. As soon as that hit, I was straight onto the hourly chart because I'm like, okay, this is it. I'm happy it got down to this level. I feel that, we're starting to trend higher. The momentum's starting to shift, and this head and shoulders pattern, it's exceeded that that target there. So this is where I'm looking to get in now. If I put this horizontal line, so typical pivot entry here, we would get in above this high here. So that's at 75.41. And looking at, obviously we've got the benefit of hindsight here. If we got it here, risk, X amount of pips, so just the low here, great risk to reward ratio. You can say that's almost like a 4-to-1 risk reward ratio. But when you're trading live, you don't have the benefit of hindsight. What I'm looking at doing is trying to fine tune my entry as close to that level as possible. So I'm on the 4-hourly chart. Let's drill down to a 1-hourly chart. Let me move this over a little bit. Okay, so this is the 1-hourly chart. Let me keep going. Okay, so now I'm going to highlight this chart. So now I've got a new potential entry at this level here at 7523. So you can see we're almost 19 pips better off just from drilling down to a smaller time frame. And this is one of my favorite patterns that I like to see. If we're near a very strong support or resistance level, and I see this first move down here, obviously suckers a lot of people in, moves up, goes back down, start to see some tails, bullish divergence. That to me is one of those almost those trade setups that gives me a lot of confidence to sort of get in at, because it's low risk, because I'm often going to be just putting my stops fairly close down around this level here. So if I get stopped out, I get stopped out. I'll look for the next entry. That's fine. But it's given me a lot of a lot of confirmation in the sense that I've got a bullish divergence. It's hit the 23 or fib level. It's on a 4-hourly chart. We're seeing multiple divergences up there as well, and it's sort of been in that downtrend for quite a while. So, looking to sort of catch that bounce on that level there. So that's on a 1-hourly time frame if we entered. Now let's drill down to a 15-minute chart. Okay, so on a 15-minute chart, whoop, let me move that back up. Whoop, I'm grabbing that again. I'll just move that over and I'll zoom in a little bit as well. Okay, so this is a 15-minute chart. You can see, we're really close to the price action now. So at this point, again, touches here. Remember how we said we've got about 15 to 30 minutes to make a decision. So it comes down here, it holds, comes back up. I'm waiting for an entry here. Doesn't get it there. So we've got to wait 15 minutes, elapses there. We get it on that next open there. So that's roughly, just over 30 minutes. Excuse me, that we would have had to wait to get in on that entry. And that was at 75.15. So an improvement of about 7 pips from the hourly chart and an improvement of almost 25 pips from the actual 4-hourly chart. So you can see, the difference here in using multiple time frames. And when you start to set these levels ahead of time, looking at them and then knowing exactly what to do when they get hit, to drill down, look for the clues, look for these entries. Pardon me for a second. Then you can really see these moves, develop. And this is, if I was to apply the fib here, I might just zoom in a little bit more so we can see. And this is what I like to do. Once I'm in on a trade, I'm looking for that move up, looking for that little test. And if I just bring that there, and you can see it's come right down to this level here. Again, the 23 level, 261.8 would have been, that level that we could have taken profit at. So rather than sort of, if I had my stop loss down here, which would have been approximately 20 pips away, and then, if we got in here, 20 pips away, 20 pips would have been, from 15 would have been 35, the 261.8 extension directly here, would have given us an extra 4 or 5 more pips. Now, if you're someone who likes to sort of, zoom back out and just go, you know what, I'm not going to go for a 1-to-1 risk-reward ratio on that. That's a strong bar there. This could be the beginning of that. This is where I start to incorporate Fibonacci bar counts. So let me just remove that. So this is where I start to look at, okay, so this is bar 1, 2, 3, 4, 5. And then you can see 5's a number, we reverse. And so that could be one that I look for. So that's 5. 6, 7, 8, we're starting to move back up again. 9, 10, 11, 12, 13, and we pull down again. So I could be looking at, okay, it's come off a fairly strong deep fib retracement. I might look for an 8 to 13 bar count on the hourly chart, and then you can see, will get us out around this particular level here at 75.71, where we had our entry at 75.16. So there's some of the things that I look at. This bar count here, this could be bar 34, so I'll quickly count. Let's have a look. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So there's another fib number there. 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34. So 34 is here. So didn't get didn't get it quite exactly, but you can see it's very close. It's uncanny how just incorporating these bar counts. You set the tolerance, whether it's plus or minus 1 or 2 bars, you just sort of get further out. That can give you a really good indication. And plus, you can see this is probably a nice fib level if I apply. So I'm just grabbing this level here. So this swing high to this swing low down here. We can see the 161.8 hit this level. And then we've got the 261.8 up at that level there, which eventually gets hit here, but then obviously it keeps moving on as well. So that's an example there on multiple time frames on a Fibonacci retracement trade, on how you can drill down to the different time frames to really fine tune the actual entries itself. Okay, so let me jump back onto presentation. Whoop. Okay, so Fibonacci Confluence setup. So this is, again, this is something that I look for, especially if I'm on a 4-hourly chart and I can see multiple swing points that I could use to find confluence levels. I'm often using various combinations of, retracement on retracement, which is often the most common, especially if you're in a nice uptrend and you can see multiple swing lows. You find one common swing high and then you draw the fib levels on that. You also have, retracements with an inverse price extension. So this is, you're drawing a price retracement, then the market starts to move down, pulls back a little bit, continues to move down. Then you use that first wave there to do a fib extension and then see if any of those fib lines intersect. Then you've got here retracement and inverse price projection. So, I'll show you some of those a bit later. Price extension on price projection. So probably less common, but, they are often things that I use as well to sort of look at, some, really big impulse moves in the market there. So Fibonacci confluence level is just, looking on a 4-hourly time frame, even on a 1-hourly time frame, and seeing if these multiple levels line up. And if they do, then we follow that same rule of how we execute the trade. So start with the 4-hourly chart, find the level, drill down to the 1-hourly chart, see if there's any other factors that confirm to that level when we hit that price level to initiate the trade, and then we'll drill down to the 15-minute chart to get in on those pivot breaks, or the if it's a long trade, close above the high of that bar that hits that level. So obviously that level needs to hold, but if it does, then we get in on the close of that high. Okay, so some Fibonacci extensions. You saw some examples live then, but this is essentially what we're looking for. Swing low, then you've got a swing high, extend that out, and it's going to give you the multiple swing points there. The key ratios that we're looking at are generally the 161.8 and the 261.8, but often I do see the 127.1 extension, come up a fair bit as well. Price projection ratio. So this is, something that I like doing as well. If I can't really pinpoint a particular level, but I can see it's close, then I'll use the price projection to sort of see potentially if that's the key level that we should be looking for. So what you would do is apply the same analysis where you identify the swing low, swing high. Now you've got your extension, but then you double click on the fib level so you can see these 3 dots come up, and then you hold and left click that and you drag that up so that the 0 line is on the C level, and you can see here we had a nice run up to the 100% level before falling off. So these are Fibonacci price projections, and you can use this to project into retracement levels and all that sort of stuff. So these are a few more examples where on a short trade, swing high to a swing low, copy that range, extend it from swing point C, and we see hit the 161.8 quite nicely. Okay, so here's the most common one that we find, where you see right here we've got a common swing high and we've got two swing lows. So I've just named them capital A and lowercase a. You applied the Fibonacci ratios, and when we sort of combine them together, you can see they both combine to give you that very strong, support level there at the 78.6 level of the minor retracement, and on the larger retracement, the 61.8% level. So this is what I like doing on a 4-hourly chart. When you see these levels come up, this is something that you want to pay attention to. When the price hits it, just, follow your strategy. Drill down to the hourly time frame, then the 1 hourly time frame, lock in on your trade, and then go for that 1-to-1 risk-to-reward ratio initially. And the reason why I start off with the 1-to-1 risk-to-reward ratio is because with any new strategy, you want to get some wins under your belt. Like, you want to just go, okay, great, set my stop, put my take profit, and you want to see it get hit. And because it's 1-to-1, you don't have to wait very long for either one to get hit. And if you start to see a few winning trades in a row, and then you see the price really move, continue to move in that favor, that's when you start to look at ways in which you can sort of expand that out, but in a systematic way. So you might go, okay, you know what? If I enter on a Confluence level, rather than go for 1-to-1 risk-reward ratio, I'm going to go for 1-to-5. Sorry, not 1-to-5. So 1-to-2, and then maybe 1 to 2.5 or 1-to-3. Just depending on what you're looking at. And if you start to do that, then you really start to increase your gains, your potential gains on that. And if you get a few at 1-to-3 risk to reward, and then you get 2 or 3 losing trades in a row, you're still going to be up on that particular trade. Whereas you need a 50-50 win-loss ratio to break even if you're just doing 1-to-1 all the time. But if you start to get used to the system, start to get used to how to apply, and really start to see these formations give you better risk-reward ratios than 1-to-1, then start to experiment and expand that out. So like, I personally start off with 1-to-1, but in my head, I'm already thinking about, okay, how can I push this out further? Okay, it's going in my favor, great. I'm gonna increase it to this level. And the first thing I do is on this particular setup, if I get in here, let's say my risk is down here, my take profit target will be there. The first thing I'm going to do is apply a fib ratio from that high to this low to see whether 50% or the 61.8% level. And if the price action permits and the 261.8 sort of shoots up there as well, then that's where I'm going to move my take profit. I'm not going to leave it so tight if I feel that this particular move has legs in it. So that comes over time, but just wanted to sort of introduce that concept of increasing your risk to reward ratio, because I think you've seen a few entries now, and you've seen with Confluence levels you get a much higher probability support or resistance level, and when you start to do that, then start to look to increase that 1-to-1 risk reward ratio. But initially, with any system, you start off with a 1-to-1 if it's got a good win-loss ratio, that is. If it doesn't, if it's a a trend following system, then obviously you want to stick to whatever the rules are. If it says go for a 1-to-3 risk to reward ratio, then you need to do that, because it's probably been back tested and proven that it's only a 35-40% win-loss ratio type strategy. Therefore, you need that higher risk reward for it to give you that positive expectancy. But with Fibonacci analysis and how I look at these particular levels, the 1-to-1 risk reward ratios, you're going to get a fairly high win-loss ratio if you do it correctly and if you get it in that right level. Okay, so let me just jump back onto the charts again, and let's have a look at some of these Confluence levels. So, okay, so I've got one here on the 4-hourly chart. So again, this is one that I was watching earlier this month. So we saw this move finally breaking out from this range here. We saw it nearly all month. I think it was driving a lot of people a bit mad, just 1% move, 1% or less than 1% move all the way through. Then finally we saw this breakout. Now, I think this move sort of caught some people off guard, but you can see a lot of stops being taken out, moved up there, and then it finally started to push back. So some of the traders that I spoke to, we're looking to sort of get long on this, and we're like, okay, where do we get in at? And this is some of the levels that we looked at. So just from this low to that high, we've got that first retracement level here. This gave us the 50% level. So keep your eye here on the 50%. I'll just move it so you know which one I'm talking about. So it's just that one there. Okay, and then the next retracement, always like to take the first swing low of the move, because I think that's often the most accurate, rather than sort of take this one here. I often like to take the one that's a little bit closer, because I'm sort of keeping in mind the guys on 15-minute, hourly, 30-minute charts, and 5-minute charts. They're not going to be able to see that swing low there. They're going to be looking at this, and that's where I'm looking to sort of apply that. Again, highlighting the area that we wanted to sort of get in on that pullback, and you can see this confluence level hit it quite nicely. There's a lot of price action here, so if we didn't break below this, that gave me a lot of confidence, just to say that every time the market sort of got below here, you can see all these tails pushing it back up, this one pushing it back up, pushing it back up, pushing it back up, pushing it back up, pushing it back up. So when you start to see that, that's just going to tell me, okay, you know what, this level is holding. We even got a confirmation there. Not a textbook perfect double bottom, even triple bottom if you wanted to call that. But as soon as we started to see this move up, some bullish divergences along the way. Some of you probably know that I like looking at the RSI indicator, and how I've constructed it here is I've got the 80 and 40 channels. So if my RSI is traveling in between this, then to me that's telling me it's in a bullish phase, and look to get in on any dips close to the 40 level. If it's above the 50, then just let the RSI do its thing. It's above 50, it's uptrending. The strategy should be buying on breakouts of new highs or on any shallow pullbacks. Okay, so that's essentially where we identified that particular area to get in on, which was just applying Fibonacci confluence, finding this level, drilling down to the 1 hourly. Let me move that across. You can see it's much clearer there. It's tested at 1, 2, 3. And if you like your chart patterns, you can almost say that was your left shoulder, head, right shoulder, neckline down along here, tested it, and then the move up. And then we'll drill down to a 15-minute chart, and at this level, okay, you can really see the levels kick in. So the entries that you could have taken, and I'm just looking at this area here, above this level here, 2268. If you want to have a second dig at it, again, wait for it to come down, close back up, 2270, and then that sort of gives you that move up. Your risk is going to be this one we had a little bit lower, like below some of those other lower tails, because we figured there's a lot of buying in this zone, so just want to put some of those in front of our stops, and then basically when you look through, you can see the market really started to hit its stride. So this was that price action I was telling you about, where it just last week, you can see from the 13th, green, 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 sideways, green, 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 sideways, green, 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 and this was all-time high, all-time high, all-time high, and again, just before on Monday, another all-time high. So it was some really bullish price action, happening there. So yeah, it's great to see, if you're positioned long, and generally most traders are positioned long in the markets because you got some form of equity holdings there, but we've when you're trading indices, and you know, don't get sucked into a lot of the doomsayers and the naysayers and the prima bears that are always talking about, you know, next crash is around the corner. Like, you know, take note of it, but always look at the, you know, your own analysis and make up your decision there, because you know, there's always enough data to sort of form both sides of the argument whether you should be long or short, you know. So it's just a matter of finding, you know, the right form of analysis for yourself, and then yeah, and then just, you know, pretty much trading that. So let's have a look at the last entry. So if I go here, so we're looking at fading the 261.8 extension. Okay, so how I set this up is on a 15-minute chart, you got a swing low here, and then you got a swing high at that level. So when you draw that out, you're going to get the 2618 around this level here. 1618 is going to be obviously a lot closer. So these trades, when you initially set it up, you know, it could be like the next session or the one after that before you start to see the price get closer to that 2618 level there. So here are the rules that I look at. So jump straight onto a 15-minute chart to identify the initial wave up, and then apply the direct Fibonacci extension and highlight the 2618 level. So when you do that, highlight the level and then wait for it to hit. So this is great. Like, I like to have a few of these setups sort of on the go, and I'm just sort of looking at, you know, other fib setups, and then if one of these come up, great, that's going to be my attention for the next, you know, 15, 20, 30 minutes, because these are 15-minute bars. So, you know, you have a, you know, that 30, 40-minute period where you can sort of enter in, set your stops, take profits. Obviously, once you get a lot better at this, and if the entry just gives it to you straight away, then, you know, it could be like a 5-minute entry, put your stop loss, take profit, and then on your way. But let me just finish off. So when the price hits that level, watch that 15-minute candle. Now, if that candle fails to push through the 261.8, then I know that it's tested it and it's respected that level. We enter on the open of the next candle. Okay, so I'm not even waiting for a close below the low of that candle that hit. I'm just getting in on that next candle, putting my take profit, which is going to be at the 161.8 level, which is here, and then use that same distance to set your stop loss. Okay, so here's an example where we apply the 261.8 extension. You can see I'm going to highlight that 2618 level. Price is going to start to move sideways, and then we get a bit of news that's going to push it all the way up there. Now, this it touches it, doesn't push through. That's my trigger. I'm going to wait till that candle forms. So on the open of the next candle, I'm getting in, measure my take profit, which is down to this 161.8 level, set my stop loss, which is going to be up here. And the reason why I do that is because I know even if I do a price projection, so I've got this range here, and then I move it up to this low here, this 261 price projection is only going to be here. So even if this does move up, it's going to hit that. There's another reversal level there that I'm looking at that is still not at my stop loss, and then, you know, hopefully that will come down. So if it does, if I do see that and it gets a bit higher and it starts to come down, then I may sort of move my profit target in a little bit. So it's not ideal, because often I like to see it just sort of maintain and sort of stay at this level, like what we see here. It sort of hits it, comes all the way down, gets us out. That's it. Move on to the next trade. But if it does get to the 261.8 price projection, and then, you know, I want to make sure that, you know, my profit target does get hit, because it may not necessarily come all the way back down to this level, because it may be in a much stronger impulse move, and, you know, I need to adjust accordingly to that. So let's jump back onto the chart. So looking at the Dow, for example, so this is one that I've got. So I've got it on a 4-hourly chart at the moment because this particular one I've had for a while. So, okay, maybe not so big. Okay, so I'll drill down to a 15-minute chart, resize that. Let me just move that across so you can see the initial analysis. Okay, the zoom's a bit out, but essentially what I wanted to show you was, this is one that I'm waiting for up here. The one that I've got in play at the moment is on the DAX. So the DAX, this is, you can see we've got 261.8. Enter here. You can see how close it got. So it just depends on your pricing. But, here, chances are this particular trade we didn't get out, but it got really close to that profit target there. So this candle just opened. Let me just get that. Okay, so this is where it opened. So when I was looking at it just before the presentation, the price was at this level here. So if I was watching this and it started to move up, that could be indication that it's filled this gap, then get out. So if the 161.8 is just below this level, you might want to, just to improve the probabilities of getting filled, move it just above so that it's above that. So that gap fill, when it does get filled, will get you out. Okay, and you can see this bullish price action where it sort of come down, boom, straight back up to this level here, and it's sort of still respecting that. If I move the direct expansion up, it's still pushed through that a little bit as well. So yeah, so that's a 261.8 extension. Let me see if we can find another one. So again, on a 15-minute chart, let me just take that off. Okay, so this move here, so I'm going to take it, let me just remove that. I'll take the moving average off there as well. Okay, so what I'm taking here, see, this is not an ideal one, but it's still a direct expansion because this is the data, this is all the data that I can see. So I've gone from this swing high to this swing low. It's pulled back where that's not our entry. Our entry is actually down here, and we can move all the way through. You can see it's pushed through this. So that doesn't quite hold. It's pushed through, so that's invalid. So we want to see it touch and then move back. It didn't quite do that, but let me just project it from here. You can see it's a bit closer. So, we may, this one we may consider, yeah, no, I probably wouldn't take this trade at the moment, but let me just move this back up and I'll zoom in a little bit to just explain a little bit more. So here we got this particular candle. It touched it, but it sort of poked its way through. So I'm looking for one that's sort of very close. This one, the next candle follows through, gets stopped out. Technically, if we did enter here, we're still in play because the take profit's here, and our stop loss, let me just use this to measure it. So our stop loss is roughly at this level here at the moment, and that's our take profit there, the 161.8. So I'm going to leave this and see if we do in fact reverse and we come back up to this level. But generally, this particular setup, not the most ideal for a 261.8. Okay, so this is the Aussie dollar. So this was just the example that we ran through before. Let me just jump back onto the charts. So again, this is the typical pivots that we look at. And this is my general Fibonacci trade setup rules that I apply. So looking at the trading bias, what are we looking to do? Is it long on a pullback? Are we counter trend trading? Are we fading an impulse move, shorting rallies? What is it that we're looking at? Apply Fibonacci analysis to identify these entry levels, which we've gone through. Start from the 4-hourly chart, work your way down to the hourly, 15-minute for entry. Obviously, before we do that, we want to check if there's confluence levels in there that exists, and if it does, then great. Then we can start to consider, risk-to-reward ratios greater than 1-to-1. If price reaches the Fibonacci entry, then we run through, these steps here. So wait for the pivot candle to form, work out the stop loss level, calculate the risk, set 1-to-1 risk-to-reward ratio initially, and then when we see that first wave up, pullback, it gets respected. We apply a 261.8 direct expansion to improve the profit target. And then now we just let the trade develop. So it's just that same process that you develop over and over, but now what's exciting is that now you've got a bit of a framework to work with, and you start to pick 1 or 2 markets that you want to keep a close eye on. So whether it's the Aussie dollar, whether it's gold, whether it's the Oz 200 index, because it's something that you're familiar with, or you might want to look at the US market and the S&P 500, for example. But looking at those, and then start to get a good feel of them on a 4-hourly, hourly, and 15-minute time frame. Start to see where these levels are. Do some, demo trades. If you don't have a live account with us, just jump onto our website, download a demo account, and do some practice with that. Keep in mind it's only a 30-day trial, but if you are a live client, then we extend the demo indefinitely for you. So you've always got live data for FX, indices, spot metals, and oil. So you can continue to keep practicing on that. And yeah, and then just using those rules to apply. What I'll do as well is just have a look at some questions that we might have. So just bear with me for a moment. Okay, so I've got a question there. What is an inverse price extension? So very good question. So inverse price extension is, let me just bring up a better zoom. So here I've got to move down. Now I'm looking for a level where I can identify a swing low to basically project a price extension. Actually, that's probably not the best example. I'll use this one here. So we've got to swing high here and a swing low there. What I'm going to do is apply that level there. So now we've got a very shallow pullback, and then we've got to move down, and it gets really close to this 161.8 extension. So that's a swing low there, and then you sort of move across here, and you can see a lot of previous resistance then becomes support here. So this 161.8 sort of gives you a bit of an indication that price can get down close to this level. Now the pivot candle, so another question there, what is a pivot candle? If I use that same example here, so you got this candle here, the low, and you're looking at the 2 lows on either side. So you've got a low here, and you got a lower low, and then you got a higher low here. That's a pivot candle. Now, if you're new to pivots and stuff like that, there's actually an inbuilt indicator on MT4 that actually shows you that. So if you go to indicators, and then you scroll down to Bill Williams, and then you select fractals, I'm just going to leave it on gray, hit that, and you can see it prints all these pivot points for you. Okay, so that's what that looks like. So good question. Okay, so in terms of questions regarding stop loss and take profits and trailing stops and things like that, that's something that I'll probably invite you to sort of give us a call and we can run you through that. Just on this particular account, this is actually my live account, but I don't have any funds in it. It's just more for demonstration, so I can't actually place any trades on this. Okay, so just having a look at a few more questions here. With the rules, well, everyone who attended tonight's presentation, you are going to receive a copy of this. If I get some time over the week, I'll put together like a bit of a cheat sheet, I guess, of some of the slides in there, so you can just sort of have that in front of you. Just give me some time with that, and yeah, we can sort of get that sent out to you as well. Okay, so in terms of the Fibonacci system, the winners and losers, it's very, again, it's very subjective. Now, remember, I'm going for one-to-one risk to reward ratios, and I'm looking at lots of different setups. I'm not looking at just the 261.8% fade, or I'm looking at just retracements, etc. But I can say overall, it's definitely over 50%. I think where my edge comes in is I'm eliminating a lot of the big blowout trades that I guess a lot of traders experience when they first started out in the market. So everything is either 2%, 1% risk, a lot of scratch trades as well. So sometimes if I do see a trade go in my favor, it doesn't really look like it's that doesn't have that much legs on it, I'll just move the stop to break even. If it hits the stop loss at break even, so be it. If it doesn't, then great, I've got a free trade, hits my profit target, less stressful. But in terms of win-loss, it's let's just say it's above 50%, but quite well above that, in certain circumstances. It's just I'm taking it over a very long time frame, so I do go through periods where it's quite high, but then there's other periods where if I'm not judging the market as well as I should or could be, then it's a lot of scratch trades, a lot of 1%, 2% losers, so okay, so great guys, I think that's it. I think I've covered most of the questions there. I do appreciate your feedback. If you have any questions, please don't hesitate to give us a call. If you have any questions about setting up your Fibonacci alerts or adding this fractal indicator, which identifies the pivot points for you, give us a call. We can help you with that. I'll work with our marketing team to get some sort of cheat sheet out. The original Fibonacci Foundation webinar is available on our website as well, so have a look at that. But other than that, we've got some contributors also writing about various macro and also technical themes in the markets as well. So we're going to be publishing that very shortly. If you have any suggestions on things that we can look at, topics that you're interested in, please let us know. Just to let you know, next month's webinar is going to be more based around trading psychology. So it's something a little bit different. I think we've done a lot of strategy type ones. I want to sort of do one around trading psychology, and actually it won't be myself that'll be hosting it. I'll be doing the intro, but we've got someone who actually is a trading coach and who does it for a living, who has helped lots of different traders. She's going to be coming in and doing a talk about that as well. So again, if you have any questions or suggestions on topics that we can look at, please send them through. Appreciate your time today, guys. We'll have the recording sent out to you very shortly. And if you have any questions on opening an account or around the account opening offers, let us know. We can run you through that as well. Good luck with your trading, and yeah, we'll see you next Monday. Take care.